Good morning and welcome to the Killik and Co market update. Today is the last day of the second quarter, so it's a good time to review market performance. On a year-to-date basis, the S&P 500 was up 14% as of close of business yesterday. What's interesting is the performance of different sectors. Last year, energy stocks did well because of high oil prices. Healthcare and utility stocks were quite resilient because people view them as safe havens, and tech stocks were weak. However, this year the opposite is true. You can see from the red colorings that energy, healthcare and utilities have been quite weak in 2023, whereas some of the big tech names have had large gains. Amazon is up over 50%, Microsoft up nearly 40%, and Nvidia up 179%. Looking at these sector heat maps can be a good reminder of why it's good to have a diversified portfolio. There's been a lot of talk this week about Thames Water, which has got itself into financial difficulties and may now need to be nationalised. The UK water industry was privatised over 30 years ago, and at the time it didn't have any debt. However, today, UK water companies collectively have over £60 billion worth of debt, with Thames Water accounting for nearly a quarter of this. Over the years, many of these companies have paid out significant dividends to private shareholders while building up debts. The cost of servicing this debt is now rising because interest rates have gone up so much, and all of this is happening at a time when significant further investment is required in UK water infrastructure in order to lessen the level of water leaks and prevent sewage from being pumped out into rivers and seas. Thames Water itself is privately held, and the structure is quite complex, so it's quite difficult to get a really good look at the accounts. But there are some water companies listed on the UK Stock Exchange, so we can have a good look at the numbers there. Here's Severn Trent over the last 20 years. The green bars show the earnings per share, or the amount of profit that has been made in each year. The pink bars show the dividends per share, or the amount that has been paid out to shareholders. You can see there are several years where the pink bars are taller than the green bars, meaning that the company has paid out more than it made. The black dashed line shows the long-term debt to equity ratio, and this has risen sharply over time as the company has become more indebted. We've got a similar story at United Utilities, particularly over the last 4 years. Dividends are still going up, profits are not keeping pace, and the debt ratio is rising. And finally this week, the Bank of England has published its latest set of data on UK mortgage approvals and UK household cash deposits. Here we've got mortgage approvals since 2006. The green line shows mortgages for new house purchases, and it's declined heavily since interest rates started going up. So on this basis, it's not surprising we're seeing a bit of weakness in the housing market. The orange line shows a decline in remortgaging activity too. This one shows changes to household cash deposits. The orange shows cash held with National Savings and Investments, which is the government-backed savings bank, and the turquoise shows other cash. There was a big increase in COVID times when people were building up savings because they couldn't go out and spend. In May just gone, however, there was a notable decline in the level of household savings, suggesting that some are running down savings to pay for the higher cost of living. Looking at that mortgage chart, it may also be the case that some people are using cash savings to pay off mortgages now that the era of low mortgage rates has come to an end. Next week, we've got no companies on the Killik covered list reporting, but we'll soon be starting another quarterly reporting season, so it should get a bit busier then. Have a great weekend, and we look forward to seeing you next Friday.